Good evening, ladies and gentlemen. Welcome to our quarterly call. We'll wait for a minute for all the participants to join in. Sandip will wait for a minute and then we'll start the call.
Sure.
Okay, so let us start the call. Good evening, ladies and gentlemen. A warm welcome to all of you at ASK Investment Managers quarterly call. I am Gaurav Chakravarti and I will moderate today's call for you. As you know, Indian economy closed the last financial year 24 strongly with its growth surpassing market expectations despite strong external headwinds. Early indications suggest a continuation of the economic momentum during the first quarter of financial year 25. The emerging robust trends in important high-frequency indicators of growth like the GST collections, e-way bills, electronic toll collections, sale of vehicles, purchasing managers' indices, and the value and the number of digital transactions attest to the growing strength of the economy. The current print at 8.2%, which is more than a 1 percentage point, and it's higher than the previous year growth of 7%, testifies our northward journey. This reflects the resilience of the economy to sustain its growth path amidst ongoing geopolitical headwinds, and that forms the part of our discussion today. And for that, we have Mr. Sandip Bansal, Senior Portfolio Manager at ASK Investment Managers Limited with us to assess the condition prevailing in the global and domestic market. And he shall take us through the highlights of our ASK Growth and India Select portfolio as well. Just to remind all the participants, ASK Growth Portfolio is one of the industry's first PMS investment approach, launched way back in 2001, and now has a track record of more than 23 years. And in this period, it has compounded at a rate of 19%. Sandeep comes with a 2 decade of work X with more than 15 plus years in equity market. He has been instrumental in managing our portfolios since the time he has joined us from SBI Life, where he was the head of investment research leading across asset classes. He comes with a strong educational background. Sandip is a chartered accountant, company secretary, and an MBA from IIM Ahmedabad. Today, we have scheduled an hour for this webinar where I would request Sandip to cover broader trends of the market and the growth drivers for Indian economy, followed by a deeper understanding of both the strategies. Also, insight on what happened in this financial year so far, where he stand now, and how he see things going forward. This will be followed by question and answers. So I request all the participants to type in your questions and queries, and we shall curate and try them answered. Over to you, Sandeep.
Thanks a lot, Gaurav. I'll be sharing my screen and hopefully it's visible.
Yeah, it's visible. Yeah, just make full screen. Yeah.
The first part would be on market outlook. So welcome everyone to the call. Firstly, obviously, the results of the recently concluded elections were not as per market expectations. It was also not as per what the exit polls had predicted, because it did not come across as what the market wanted. We got the market reaction that we did yesterday. How are the markets hence likely to behave? We think that in the near term, the markets could wait for some more clarity to emerge on aspects like what will be the shape of the new government, what form the coalition will take, what ministries get allocated to various coalition partners, what would be the priority, the agenda of this government, and a lot of it could get cleared in the budget and the upcoming months. During this period of time, it is quite likely that short-term market movements and again stock-specific movements could get impacted, accentuated by domestic FII flows, depending on what positions the different asset management companies have on different stocks and markets, and what view they take on the likely course of the economy. Markets, other than this, would also be focused on the monsoons. There are chances that because of the onset of La Nina, the monsoons this time are going to be favorable. Predictions are somewhere like that it could be around 106% of the long period average. This could aid farm incomes and rural recovery. And obviously, on the global side, the markets would be focused on the interest rate actions that are taken by various central governments. That was earlier expected in the first half of the current calendar year. Now it is likely in the second half of the calendar year. And also the ongoing crisis on the geopolitical side that we are seeing both in the Middle East and in Europe. What follow-throughs happen will also have an impact on global growth and hence markets. So the markets, from having taken a relatively longer term view just a few days ago, could now be more determined or more action oriented based on short term developments and short term, near term events that could play out. However, it does seem that at the broader level, policy continuity is likely to remain. That is something which was also, has been coming through from the party that is that is potentially likely to form the next government. And overall, the long-term India story remains intact because the fundamental drivers of the economy haven't absolutely changed. Also, in the recent release of various numbers that we've seen, the numbers have been quite strong. So on the GDP side, Q4 numbers were good, and FY24 we ended with a GDP growth of 8.2%, easily the fastest growing economy amongst the G20. And this is on back of a 7% growth that we saw in FY23. On the macroeconomic side, the other things are that inflation continues to remain under control. The current account deficit continues to fare well. Our fiscal deficit numbers have also been better than what were budgeted or expected, also aided by good tax collections and a healthy dividend by the RBI. The currency continues to be stable, so the macroeconomics and externalities continue to be good for the country. As far as markets and earnings are concerned, they were also ahead of expectations in the recently concluded earnings season. The number of beats were greater than the number of misses. The earnings delivery were also relatively broader, and it was not that it was just concentrated in a few sectors. So overall, the performance of India Inc. continues to be strong and ahead of expectations. Nifty earnings grew around 25%, and in the ensuing years, FY25 and 26, it is expected to grow in the region of around 15%. In terms of revenues, while the revenue growth was at around 7% or so, the bottom line growth for the quarter was around 12%. Domestic cyclicals in the spaces of auto, real estate, the capital expenditure driven businesses and BFSI sector continues to deliver superior earnings, while sectors like energy, metals, and IT had muted earnings, and some of these subsectors also faced earnings challenges. But broadly, everything combined, the earnings were ahead of expectations. Now, coming to our portfolio, the ASK Growth and the ASK India Select portfolios, our broad market cap segmentation continues to be very well diversified. We have around 55-60% of the portfolio in large caps, around 30% of the portfolio is in mid caps, and around 10% of the portfolio is in small caps. We do not manage our portfolio having any specific market cap targets in mind. These are just based on outcomes, and these numbers are as of now. And obviously, if we make changes to the portfolio, they do change. But broadly speaking, it is unlikely that there's going to be a very big skew towards, let's say, small caps or such like that. We are likely to carry through a very balanced portfolio. In terms of sectors, we have good diversification with around 15% exposed to banking. And this is a broad array of sectors that we are exposed to. Overall, we are having around 28 stocks in our portfolio, and we will continue to follow this strategy of taking concentrated positions and not run our portfolio with more than 30 stocks. In terms of actions that we've taken since our last call, so we have exited a few names on the consumption and the healthcare side, and a few names on the BFSI side. And we've entered a couple of names, one on the power side and one on the hospital side. Overall, not too many changes. The names that we've entered, we are very confident on the long-term growth trajectory of these names. And we thought that the opportunities presented by them are better than what return potential the existing names which we exited had. In terms of the performance of the portfolio as a basket, in terms of earnings growth, in the recently concluded quarter, we saw an earnings growth of 10% for the portfolio. The number would have been a couple of percentage points higher had it not been for the oil marketing company, Indian Oil Corporation, which saw a decline in earnings. While it missed estimates, the muted earnings or the degrowth was built in, though it degrew more than what we had expected. Versus that, the Nifty earnings had grown about 12%. If we look going forward for FY25, we are expecting an earnings growth of around 16% for our portfolio. And for FY26, we are expecting an earnings growth of around 21%. And broadly speaking, the earnings growth of the underlying portfolio continues to be superior to that of the market. And it is not that we are forecasting earnings which are likely to be far higher, but that has not been the case historically. Historically speaking also, if we look at what we own in our portfolio today, the earnings growth of the portfolio companies, these are last 5-year CAGR profit numbers, they have been much higher than the market. Hence, our confidence that going forward as well, these companies would be able to deliver better earnings growth than the overall market. In terms of the key metrics of the portfolio, as we discussed, the earnings growth is superior than that of the market. If we look at the return on equity and the return on capital profile of the portfolio companies, they also continue to be healthy, with the return on capital being in the ballpark range of around 35%. The balance sheet profile of the businesses in the portfolio also continues to be very strong, with leverage or debt to equity ratios being about close to 0. The P multiples of the overall portfolio are in the region of around 20 times, which are about comparable to that of the market, or maybe at a slight premium, but with a much higher quality profile in terms of return on capital, better balance sheet profile, as well as better earnings growth. So overall, the portfolio continues to remain invested in robust companies with solid long-term growth prospects. Gaurav, I would like to stop here for questions because I think that there are going to be a number of questions in this market environment, and it will be good to address as many of them as we can. So thank you so much, everyone.
You're absolutely right, Sandeep. As we discussed before the call, that we need to make it more interactive so that questions are get addressed. And in the meantime, we have already gathered some question in advance to be asked. In the meantime, and first of all, I like to thank you for the brief on the portfolio and the sectors. And I believe the way you demonstrated, things should continue in our to do good in our favor. So now in respect to the questions which I've already got in the earlier before the call, I'd like to ask those questions first. And in the meantime, I request all the participants to type in your questions on the chat box. We shall try to curate all of them. Sandeep, let me read out exactly like what you wrote on the commentary this time around, that the market will be closely watching the results of the elections and the upcoming monsoon in the near term. You already spoke about that. Over the medium to long term, the various policy initiatives taken over the past few years to structurally transform the manufacturing sector and the heavy investment done in the infrastructure space, together with global realignment of supply chains, will translate into acceleration in GDP growth. Now, my question is, the narrative remains same, or is it due for some change after yesterday, what happened in the market?
Right. So that's a very valid question to ask, Gaurav. In our view, there is no change to that narrative. The reasons are very simple. We have seen coalition governments in India in the past as well. And this was the case, let's say, in the 1990s also. This was when we saw major reforms in India. This was also the case in late 1999 when we had a coalition government. And then also we saw a lot of major reforms in the country. And there is no reason to believe that this government, the potential government, with a very large proportion coming from one party in terms of numbers in the coalition, should not be able to drive reforms. So that is one bit. The second part, Gaurav, is that a lot of the economic reforms actually do not have the requirement of any major legislative actions per se. One could potentially argue that the number of bills that were likely passed in the previous Lok Sabha, could there be some slackening in those numbers? Potentially could be. We really don't know. But a lot of the economic reforms are more about execution. It is more about allocating money to the right sectors and making sure that the capital that is allocated by the government is very well directed, and the programs are executed well. I don't see any challenge to those actions or activities just because this becomes a coalition government. And also, there is no reason to believe that any of the coalition partners would have any opposition to economic agenda, which would be, let's say, about allocating more money towards manufacturing or building out the infrastructure in the economy. Where the coalition partners could potentially have a greater say, and we are all guessing here, is perhaps on social issues or state-specific issues, and on national issues and national spending aspects like defense, manufacturing, infrastructure. I don't think that there would be any challenges. And overall, if we want to actually leverage the demographic dividend or the potential that we have in this country, then it is obvious that that can be done largely through the route of manufacturing. And hence, job creation, employment creation, which would naturally be the objective of any political party, would find a lot of support in the policies of the government. So we would like to believe that policy continuity is likely to remain. Now, on the other aspect of global diversification of supply chains, I think that is something which is likely to continue. China plus one, or because of increasing cost, Euro plus one, because of risk management, China plus one, or whatever. I think these activities are unlikely to stall. There is unlikely to be any change which will impact these sectors per se. Could stocks react in an uncertain fashion in the near term, given that there has been a good upward price movements in many of the names in the sector in recent times, given stock-specific positions of individual asset management companies and investors? Could there be strong reactions either way while people wait for more clarity? The answer is yes. But I think the long-term or even the medium-term earnings growth trajectory and outlook for these sectors remain.
Thanks, Sandeep. And I have some follow-up questions on the similar lines. I'll go one by one. Like during our last call, you spoke about PSU under the energy/defense theme. You said you will analyze this space more closely since we have started adding stock here and will drive more investment in these areas. Now, what's your take at the current moment? You always speak about the latent value. Is the latent value still there, or is the narrative change, or you can say it's a structural story? This has nothing to do what happened yesterday.
Right. So PSU names, if we look at it, they have greater presence on the infrastructure side in terms of energy. They have greater presence in defense. They have a good presence in the lending space. We are exposed to PSUs per se in all of these spaces, not because they are PSUs, but because we like them as businesses. And we believe that they would be able to deliver good earnings growth, and they are solid businesses which are seeing good long-term growth trajectory. Does the overall broader picture for many of them change? The answer is no. That does not change because the long-term growth trajectory remains intact. We have also seen that for many sector-specific aspects, it really is the fundamental demand which the Indian economy generates, which is more important than the government in power. So aspects like energy, aspects like electricity, these would be fundamentally driven by the fact that there is a demand or there is a need for the same, and concomitant to that, let's say the financing needs for putting up additional power capacity, etc., etc. So I don't think that any of these aspects change fundamentally, structurally, or from a demand or from a growth perspective. As I said, near-term stock-specific movements could require risk management tools or strategies to be put in place. That could be done. But broadly speaking, we don't think that there is a change necessitated by the event yesterday to have a relook.
Thanks, Sandeep. Again, on the similar lines, like the capex oriented stock, we speak about a lot of capex is happening across the segment, the 3D capex, right? So if I segregate from the 3D effect, capex of household, private, and government capex, is the government capex is still on, or that sector or that particular capex will need some due course of changes depending on what happens going ahead in the cabinet?
So this government over the previous government over the last 5 years has been continuously increasing the allocation from the budget towards capital expenditure in the economy. And that was also projected in the year FY25. Broadly speaking, I don't think, and also based on whatever commentary that we've heard or seen or read, it doesn't seem that all of this is going to change. Obviously, we will get to know more about this during the budget. And, because of this uncertainty, so there was a lot of presumed certainty before yesterday. And, some uncertainties around these aspects have come through in the minds of investors, because of which we saw whatever movements we are seeing in stock markets. But it doesn't seem that, any of this is likely to change. What we also need to keep in mind is that central government is just one engine, obviously a key engine in driving capital expenditure in the country. But, there is corporate private sector capex that is also, likely to pick up. Then, FDI could also be a, big driver, plus, private investments from the household side. It could also pick up. So all of these things are likely to add on. And when there is demand in the economy, and there is demand potential in the economy for the longer term, and when I think the markets also get confidence that things are unlikely to change as much as they were fearing, I think that will also similarly will with time will also get reflected in the stock prices as well. So yes, I think that all of this is unlikely to undergo any change, and the thesis kind of remains intact. And while we've seen the capex being kick-started by the central government, I think the other engines will follow suit.
Thanks, Sandeep. Now I have a very interesting question out here. I'll club two questions together. The first question says that, the portfolio volatility looks a little on a higher side, considering the movement of the stocks in the last 2 days. Like the question is that, are you chasing returns with higher risk? And on the similar way, other person is asking, can you add more in this strategy at this moment? And how do you phase it out in next 6 months? So if you can, answer, I guess your answer will address both the questions simultaneously.
Sure. So obviously there was heightened volatility in the markets itself in the last over the last couple of days, and that would also get reflected in the portfolio. The portfolio had a good representation coming in from PSUs. We are holding leading PSUs in this portfolio. So we have names like SBI, REC, Coal India, etc. Sorry, SBI, REC, and then we have BHEL. Then we have, on the defense side, we have Bharat Electronics. So because there was volatility specifically in these names as well, that got reflected similarly in the portfolio. Overall, if you look at it, the portfolio is well diversified across BFSI, consumption, oil and gas, infrastructure, engineering. So it tries to play the broader economy per se. What is true is that we are seeing greater growth momentum as well as greater growth potential in some segments of the economy, and those segments of the economy are manufacturing, infrastructure, energy, defense, and those kind of broader spaces. So like we also hold IOC in this portfolio. So and hence capital was allocated towards that segment over the last few quarters, and hence and those segments did get impacted in the market over the last few days, and that was the reason for the volatility in the portfolio as well. As we discussed, we don't see anything structurally altering. Near term, market movements are very difficult to predict. Longer term story and earning numbers remain intact. So yes, it will be a good time to allocate uh, money towards this portfolio. If one inherently believes that the India growth story, the inherent demand, the longer term outlook kind of remains intact, then I see no reason to allocate more capital to the portfolio.
Thank you, thank you so much, Sandeep. Now, coming to the next question, that when I'm talking about the growth and the future of this portfolio, both the portfolios, in respect to the performance, last 1 year has been good in specific. However, we are marginally down for the benchmark. First of all, please address what were the detractors in specific, and what do you think will help in lowering the gap going ahead, or rather, creation of alpha in the portfolio.
Right. Over the last year or so, what has impacted the portfolio from an alpha perspective, has been one of the sectors has been chemicals. In chemicals, what we have seen is that there was dumping by China globally, because Chinese demand did not pick up as strongly as was expected. Plus, we had some company-specific issues in one of our stocks. Because we run relatively concentrated portfolios, it had a significant bearing. So that was one of the reasons. Secondly, our stocks in the BFSI space did not perform as well as we had anticipated. Then thirdly, there was also the healthcare stock that we were owning in terms of DVs that was going through an elongated period of underperformance. Some of these stocks we have exited from the portfolio wherever we believed that the earnings growth are unlikely to pick up, and they are going to be not going to be as strong as we had originally anticipated. One stock on the chemical side we continue to hold. Fortunately, it has seen some good performance in the recent times, but obviously, it did impact performance in the last 1 year. We have pivoted the portfolio or given more direction to the portfolio in terms of increasing its exposure towards those sectors of the economy which are seeing greater growth momentum, which is manufacturing, infrastructure, energy, defense, basically the capital expenditure side of the economy. Now that those sectors did see volatility in the last couple of days, but as we believe that the longer term growth story and policy direction is likely to remain intact, we continue to remain positive. So that we believe is going to drive the alpha generation in this portfolio. That is one bit. The second bit is that the parts of the portfolio which we continue to hold in the other sectors, like BFSI, consumption, and healthcare, etc., we believe that they have good valuation potential, because earnings in many of the names are coming through, but perhaps they are not getting the due because the market was looking elsewhere, the focus was elsewhere. But because of earnings coming through and time passing, they have good valuation potential, and that we believe is also going to get realized over a period of time. So both of these factors combined is likely to help us in alpha generation in our view. In addition to this, whatever changes are required in the portfolio on a continuous basis, from a return perspective or from a risk management perspective, we will be continuing to do on an active basis.
Great, Sandeep. Now, if I ask you, what should the current style of investing when someone to add money, it will be in staggered manner or lump sum? What do you suggest, or what do you advise rather?
Gaurav, it is always good to add money on a relatively staggered basis, because what happens is that if a person puts in money today and there is some movement in the adverse movement that happens in the stock market a few days down the line, then emotionally one does not feel very good. I would like to believe that obviously at some points of time, markets do provide good opportunities. And if those opportunities come through, then maybe one should put it looking at in a lump sum fashion rather than in a staggered fashion. Or if some big event is coming through and one would like to take a specific view on how that event is likely to unfold, based on that also one could decide to put money in a lump sum fashion. But overall, because it is very important for one's emotional well-being that one does not see a lot of disruption in the way one is allocating capital and the way it is deployed in the markets, it is good to put in a staggered manner. How much staggered it should be in terms of time really depends on one's own risk appetite. I would like to believe that the medium term, longer term story for India remains intact. Could news flow, events, how investors are positioned both on the domestic as well as the FII side, could they impact near-term market movements? The answer is yes. And it is very difficult for anyone, and especially for us, to predict market movements in the short term. And hence, staggering money could be good. And it also depends on one's own individual confidence level of, how one views policy, government, growth, etc. to come through. So, one could do it stagger it over a few months.
Perfect, Sandeep. Now, what do you think that, is the chase is on small and mid cap right now? Or I can say that, it is inching towards large cap now, or maybe the high quality, high growth companies will be back in center stage. What's your take there?
So that's a pertinent question to ask. See, quality alone is not going to drive returns. Sometimes quality is also taken to be a good hiding place, especially during uncertain market times. So if any fund manager, asset manager views the next few months, or let's say time till the budget or whatever, or maybe even beyond the budget, to see how the government finds its rhythm, how the coalition kind of works together, or to get greater confidence on whether the policy initiatives are going to continue or not. And during that time, one might want to park money in a few sectors or spaces which are perceived to be good quality. But one would need to take a call or a view as to whether that good quality is those good quality spaces are going to give good growth as well, because ultimately returns are going to be a factor of both, and growth is an important contributor as well. We invest in good quality companies, but we would not like to invest in low growth businesses. We would continue to like to invest in businesses that are growing at a good pace. Yes, in the near term, till markets get confidence, investors get confidence, could some of those relatively higher quality perceived sectors, spaces, businesses, but which might not necessarily be very high growth, get precedence? The answer is yes. But I think as markets gain confidence, that allocation could again shift to businesses and segments where the potential not only for medium-term growth, but also for longer-term growth is relatively higher.
Thanks, Sandeep. Sandeep, your take on the current interest rate, whether it has picked out, and as you know, when interest rate goes down, in the economy, there's a downward pressure on the bond yields, which always favors the high growth, high P companies. Like in our sense, like what do you think the interest rate is going to soften very soon, and how it's going to impact a few sectors? A question specific to IT sector has come, whether it's going to benefit IT sector, and what's your call basically on it?
So interest rates coming down, has been an expectation, honestly speaking, for a while. Earlier, it was expected that this could potentially happen in the first part of the year, calendar year. That did not happen. And now the expectation is that obviously it will happen in the second half of the calendar year. Domestic interest rates, in my view, are going to follow in terms of cuts, if any, the global interest rate environment. It is unlikely that RBI is going to cut rates in India before the Fed cuts rate in the US, even if domestic inflation undershoots the RBI's expectations. When is it likely to happen? Honestly speaking, the Fed has said that it is going to be data dependent. And based on the inflation data in the US and the growth inflation dynamics, it is going to take a view. It could potentially happen, in the last quarter of the calendar year. The IT stocks specifically are likely to be more influenced by the demand environment in the US. If the IT spending from US companies does not pick up, then it is unlikely that the IT sector per se is going to view a very good stock price momentum. Obviously, because there has been a good level of underperformance in this sector, any rate cut it will help support the sector re-rating. There is no doubt about that, because there has already been underperformance, and the sector is relatively attractively valued. And hence, to that extent, could there be a leg up? The answer is yes. But the growth rates for the relatively larger names in the sector are unlikely to be very high, because it's a relatively mature sector, and for the larger companies, because they have a larger base, growth rates are unlikely to pick up very strongly. But could market in a declining interest rate environment react even to small incremental changes in growth, given where the valuations are? The answer is yes.
Thanks, Sandeep. Now we'll move forward to the next section of the call. We'll take a few stock-specific questions. In the meantime, I request all the participants to type your questions. We'll try to curate them. So now, the first question, we have weight in Bharat Electronics, and in a recent report by CLSA, they have downgraded them, citing the expensive valuation. And considering it has the highest weight in the portfolio, around 5.5% portfolio weightage, what's your take on this particular stock?
So, Bharat Electronics remains one of the larger and best positioned defense companies in the country. The growth rates are likely to be in the mid-teen kind of a range. Since the time we started adding the stock to the portfolio, has the stock run up quite well? The answer is yes. Obviously, there are various research reports and brokers in the market, and they would have different their own individual views, which is fine. We take our own view on each stock. Have the valuations gone up since the time we entered or over the last few months? The answer is yes. Are the valuations any longer cheap versus at the time that we bought the stock? The answer to that is also no. The valuations are no longer cheap per se. But the earnings momentum has been good, and the longer term growth outlook also remains strong. So we will take a view on the stock based on, yes, it is one of the relatively higher weighted stocks in the portfolio. So, based on, from a risk management perspective, do we need to adjust weights, etc.? We'll obviously be taking those calls regularly, but we believe that, and whether if we get a better opportunity elsewhere, we could take out some money from that stock and allocate it somewhere else. Or if we believe that the earnings growth trajectory is getting altered, or if the business itself is getting, changed substantially, we could take a view if required. But, otherwise, just because the stock has done well, that alone would not, so expensive valuations in itself is not the only criteria based on which we are going to decide. Obviously, it's one of the very important contributors to our decision making. But there are other factors as well, like growth, quality of business, longer term growth potential, outlook, etc. Yes. So, we continue to remain invested.
Thanks, Sandeep. Now, Sandeep, a repeat question from the last call which you did in the quarterly call, and today you also spoke on it. I remember in our last conversation, you spoke about the negative margins of the chemical sector as China, in some sense, dumped materials. And you could see the same for our stock like Navin Fluorine, which negatively contributed to the returns of the portfolio. And, it still continues to disappoint us. Your take on the stock and the long-term story in the sector still remains intact or not?
So the longer term story does remain intact. Yes, there was a bump, and there was a speed breaker in some sense, um, and due to the China macro not playing out as per expectations, then there were some company specific issues because the MD, during whose tenure the company had a very good run, he resigned. Now they have got a new person in place. The stock in recent times has done well. For all our positions, we are continuously evaluating them, both from a sectoral perspective as from a business perspective. So that process is underway all the time. From the overall sector point of view, I think the longer term trends for the sector, either in terms of domestic demand, import substitution, global diversification of supply chains, all of those remain intact. Stock specific calls, obviously, there were certain developments in the company. Now, some positive developments have happened. Earnings in the recent past have not been that good, but we will take a view based on how we believe the earnings trajectory is likely to play out. Uh, we also, as I said, are cognizant of valuations at the time of entry as well as exit. So, that is again an important contributor to our decision-making process. So, all of this combined, because we believe that a lot of negatives had played out for the company, the stock price had also corrected quite a lot. And, just because the stock price had fallen, we did not see a reason to sell the stock, and that is why we held on. We've recently got some benefits, and we'll keep evaluating the position based on our view on growth and the valuations.
Thanks, Sandeep. Now, a question on very well-known infra bank, REC, how the balance sheet look like for them at the current moment.
So REC bore a lot of the brunt of the market yesterday. The balance sheet continues to be good. REC remains a very important player in the power value chain because it's one of the most important financiers to the sector. The ROEs of the bank continue to be good in the 18 to 20% region. Valuations after yesterday's fall and today's market movements are in the region of around 1.5 times or so. So, we continue to be positive on the name. The fundamentals of the company continue to be good, and the outlook for the sector and one of the largest players in terms of financing in the sector also continue to be good. So we are holding on to the name, Gaurav.
Thanks, Sandeep. A reminder to the participants, as we are nearing the end of the call, request you to type in your questions. We shall try to curate them. Now, the next question is, Narayana Hrudalaya, which we added recently in specific, is not able to get into its groove from the time it's in our portfolio. Any specific reason for it?
So the hospital sector per se has witnessed relatively muted earnings in recent times, both on the top line as well as on margins, and that includes Narayana as well. That is one reason. Secondly, the sector has also had some negative news flow because there was some PIL case filed before the courts regarding overcharging by hospitals and the government was directed to frame some policies, regulations, etc. in this regard. So there was this overhang as well. Uh, Overall, we believe so. This is like a 2.5 to 2 to 3, 2.5% kind of a position for us in the portfolio. Overall, we believe that the earnings growth potential for the business remains strong. They are taking a lot of new growth initiatives, including enhancing their bed capacity. Valuations for the business continue to be attractive, and hence we continue to, while the stock has really not performed, that alone is not a reason for us to take a view. From a business standpoint, from a growth perspective, from the outlook on growth in terms of the initiatives that they are taking, we remain convinced, and hence we remain to continue to hold on to our position.
Great, Sandeep. Now, question on our consumption stock, which is again on the rise right now. Like Titan, despite good numbers, it continues to disappointed. What's the issue specifically out here?
A for Titan, unfortunately, valuations is always a concern for the markets, given the brand, the trust associated with it, its leadership position. In spite of delivering on the growth numbers, valuation does remain a concern for this stock, and because of which, at points of time, it does go through a phase of underperformance. What had also happened in recent times is that there has been a good jump in gold prices, and it is often believed that if gold prices rise sharply, it could impact demand for jewelry. And jewelry remains the key contributor to Titan's business, while they have other businesses in eyewear, in fragrances, saris, etc. But the most dominant stock price driver, business driver remains jewelry. That was the other reason. Thirdly, they had given a certain a growth guidance for a 5-year kind of a time frame. They did very well over the last few years itself, and then it was believed that hence the growth going forward is unlikely to be as good because a lot of the growth has already been front loaded. So I think some of those concerns have also been addressed, but the market does get worried about growth, especially given where valuations are, and also if that is combined with the gold price context that we saw. So I think that was the reason for the stock to not perform as well as it potentially could have,
Thanks.
given the growth numbers or earnings delivery.
Right. Again, on a similar lines, APL Apollo, a lot of promises that's shown. Now, what's happening? What's fever it's catching of late? APL Apollo tubes.
So APL Apollo, the recent quarter was not as good as was expected. Volumes were flattish. Margins were also not as per expectations. The reasons for volumes and also margins was that there is in this business there is always a play between tubes from primary steel and secondary steel. And so basically tubes from secondary steel, when the prices of secondary steel, the spread between primary steel and secondary steel increases, what happens is that the demand for tubes made from primary steel is impacted, and also the margin gets impacted, right? Basically, when the secondary steel becomes far cheaper than primary steel. APL Apollo Tubes makes tubes from primary steel, and in recent times, the producers of tubes from secondary steel have benefited more. They could capture, because secondary steel prices were more favorable, they were able to price their products better, and hence they could garner some market share from primary steel tube makers. And APL Apollo, being the largest player in this segment, got impacted. And because of the differential or the spread between primary and secondary steel, their margins also got impacted. Again, while these aspects do have impacts in the short term, for a quarter or two or whatever, over a period of time, they normalize. And given the distribution strengths of the company, the product portfolio of the company, the reach of the company, the capacity of the company, we believe that very good volume growth is in the offing for the next few years. And given their higher share of value-added products in the portfolio, margins, etc., are also likely to come back. And hence, we remain bullish on the stock.
Thanks, Sandeep. Any specific reason why Sona BLW is not part of growth portfolio but present in India Select? Like, are you doing such adjustment?
There's no specific reason per se. It is just that for buying Sona BLW, we need permission from our investors because of certain compliance requirements. And hence, the position in India Select was taken before those compliance requirements got activated. And in the growth portfolio, it is still awaited from the approval is still awaited from a few clients, and because of which you see the difference in these portfolios. There is no other reason.
Okay, great. Now I'll take one last question for the day. Like, in the current context, how things schemed in the last 2 days in specific, how is the relationship faring between the railway segment and Ramkrishna Forgings? What's your call on Ramkrishna Forgings currently?
So, Ramkrishna Forgings, we continue to remain bullish. The company is, would be catering to various demand requirements on the railway sector. We believe that the infrastructure sector story in the country continues to remain very much intact. It is the basic latent demand that is generating from the economy, from the country as a whole, and unlikely to be disturbed by any events. And anyways, we don't believe that this event is going to change the policy course that is likely to be taken over the next few years, and which was over the past many years as well. So Ramkrishna Forgings is very well placed to leverage that opportunity. And we continue to be bullish on the name.
That's great, Sandeep. Thanks so much. You helped in clearing a lot of air, which is around right now, and I'm sure all the investors will take due cognizance of the same. And I'm sure it has given a lot of clarity to them as well, and they'll grab the opportunity, considering a particular quote in mind, which is coming of Benjamin Graham in the short term. Equity markets looks like a voting machine, but in long term, it's a weighing machine. So I'm sure investor will take this as an opportunity and grab it with both their hands. And with this, we'd like to end the call. Before that, I request you to just give us small conclusive, closing comments on the call, and then we can end it.
So we would not be too worried about short-term market volatility. Obviously, there would be risk management practices or tools that one could initiate based on near-term movements. But other than that, we would continue to focus on the long-term earnings growth trajectory and the growth potential of the country. We would like to believe that policy continuity is likely to remain. The inherent latent demand potential in the country continues to be very strong, and the portfolio is very well positioned to capture and benefit from that across sectors in the economy. And thank you so much for all your questions, and thank you so much for your patient hearing.
Thank you, Sandeep. And I request all the participants, in case you have missed out any questions, you can, of course, write back to us on our official email IDs. We'll definitely reach back to you. And thank you again to all the participants for attending today's call, and we shall be sharing a recording of the same. And this concludes today's call. Thank you, everyone.